Gentlemen, thank you very much for both your presentations, George and Marcus. We will have 45 minutes to dig a bit deeper into some of the topics that you have raised. Towards the end of our discussion, I'll also invite questions from the audience. We were sitting together a year ago at the first Swiss Value Day, and we were kind of excited back then because there was a revival in value going on. And, you were talking about after a long period of drought where all growth was en vogue and now value was coming back. Now, I'd like to start with the market today, because since the beginning of this year, the market was the broad market, the broad indices, was basically driven by a handful of mega cap companies, the Magnificent Seven or the Glorious Eight, they are called: Apple, Microsoft, Nvidia, Alphabet, Meta, and so on. George, I'd like to talk with you, to start with you. What do you make of this market? What is happening here?
I think it's the same mechanism that we had around COVID. People are very uncertain. You see momentum in some of this tech stuff. There's a nice story, AI. We latch onto that, and so you buy that. It's going up, so you buy more of it. You can't lose by participating in that. So I think that's what's driving the large tech stocks. And Nvidia surprised enormously, so you would expect the stock to pop. At the same time, we have been seeing that the story that we were talking about last year, that people are buying stocks on the basis of valuation, that has been happening. It's just the last couple of months, there's been a switch out of it. And I have a feeling, I don't know this, but my feeling is there's a lot of algorithmic or mechanical trading out there, which just basically takes its signal from certain macro indicators like interest rates or momentum, and then it switches very quickly between things, because some of the movements then you see are not fundamentally driven at all. But so I think what's happening now is going to end fairly soon, but I don't know. I shouldn't predict things because I don't know. But my feeling is it doesn't have the legs it had before, because I think people are starting to realize that AI isn't going to solve all the world's problems. But
I'd like to quote from Fred Hickey's High Tech Strategist newsletter. He wrote in early 2000, so a little more than 23 years ago, quote, "The stock performance of these 6 mega caps," back then it was Cisco, Intel, Dell, Lucent, and names like that, "of these 6 mega caps has created a virtuous circle. Since they are where most of the market's gains occur, momentum-driven investors keep pouring money into these names and they keep going up. Mm-hmm. The stock market's breadth is getting narrower and narrower. With interest rates soaring, financial stocks have come under pressure. Investors' response is to put even more money into big cap tech stocks and semiconductors." This was 23 years ago. You could switch the names and it sounds like today. Carlos, is that, in your view, an apt parallel, that what we are seeing today is has an early 2000 feeling to it?
To a large extent, yes. I would qualify it a little bit, but we were discussing yesterday. You take a company like Cisco, which, as you know, they make the routers for internet, just for Wi-Fi and all those things. Well, in 1999, everybody was convinced that the internet was the future, and everybody was right. And Cisco was the market leader, and you could make an analysis as just the Marcos did, good business, good management, excellent, one of the best CEOs in the world, Chalmers. Well, the share price today, and the company has done extremely well ever since. So they're still market leaders, they're still making money. It's a wonderful company from any point of view. Well, the stock price today is lower than in 1999. The only point wrong with the 1999 analysis was the share price. I mean, everything people said about the company was true. It was a wonderful business, and it is a wonderful business 25 years later, but people way overpaid now. I would like to introduce just one. I think a lot about this value versus growth. Obviously, value versus growth, it's kind of simplistic because growth is part of the value of something, and even growth investors want to buy valuable things, obviously. So one way to look at it, instead of thinking growth versus value, or value versus growth, would be fundamental investing as opposed to narrative investing. In fundamental investing, you just make some numbers and say, well, I want to get a whatever, 10% return on my investment, which is what you do when you buy any business. Have to put this many millions and how much money I'm going to make every year after this. And if I believe in these numbers, okay, this is a good investment or it is not. That's fundamental investing. Narrative investing is the internet is the future. These guys are market leaders. Let's buy them at any price. Well, 25 years later, you're still losing money. So I think this is happening today with some of these companies. I don't think there is anybody in the world that can, with a straight face, say what Nvidia profits are going to be in 10 years' time. So there's no way you can do fundamental investing. Some things will work out, and most will not, because people are paying for an idea not based on the numbers. The small difference is that those mega caps today are better companies even than in 1999. I mean, Cisco was a great company, but Apple is much better from a strategic point of view. So these mega caps today, with the exception of Tesla, I would submit, are expensive, but they're very good companies, and they are not that expensive. Well, Nvidia probably is, but yes, it is a very similar thing, which again shows that cycles in markets that last 25 years, because this is the time that people work in the industry. Very few investors today, particularly younger analysts, etc., portfolio managers, were there in '99.
Marcos, how do you deal with, let's stick with the technology theme just for a few more minutes. You own ASML, for example, in your fund. Great company, almost a monopolistic structure, high valuation, and still you are value managers. How do you deal with that? Kind of having this great company, also seeing that its valuation is going up, and still you keep it.
Yes, it's basically we've been in Apple for 10 to 12 years. So we bought Apple. We've been in Accenture. We've been in ASML, and we are there waiting for the correction to buy some of the big guys also because, as Carlos was saying, Apple, the business is fantastic. So the qualitative analysis for ASML is impressive. So good business, this is a monopoly. They have IP. They have everything. So from a qualitative, it's a no-brainer, as we say. Then you go to the numbers and you try to understand what can this be, what the value of this. And this is a tough job because in tech, the most important assumption is growth. So what we do, as an example, is to build a dual model or two-stage model, which is a discounted cash flow, where we think this company can grow 10% for 5 years or 10 years, and then we normalize, because we normalize everything. We don't want to have 10% growth forever, because then you buy at any price, right? So in the case of ASML, I think we have in growth in sales 10% until the end of the decade. Then we normalize to a kind of 5 mid-single digit, margins going to what the company guides, because we see no reason for this company not to meet targets, and then we normalize them a little bit, we normalize the returns, and then it's very easy. Even with that, you don't get a 20% return now. So now the return on ASML is maybe 12%. It's a category 2 for us. It's suitable because you always have technological risk. So in a tech company, you have tech risk. You have always tech risk. You can have an innovation that completely disrupts the thing. So this is what we do. We do a model, and with the case of ASML, with the 2 parts model, we can value it relatively decently, conservatively, and get a good return, which is 12%. with a lot of positive options because we think that they can even beat what they say. So this is why we are invested. We like to be invested lower, but it's a 12% return. This is why we like a lot to have intrinsic value and IRRs. What we were trying to explain with Nestlé. Sometimes you look at the intrinsic value and then the stock is there and you sell. And then you say, well, it's still at 10, 11% with a lot of positive options. Let's wait. And then you redo the numbers a year later, more cash flow, more margin, more return, and it's even better, and the outlook is better, and you redo the numbers. This is why the two aspects help us. So this is the case for ASML. And we agree with what George was saying, and we want to buy tech, and we will buy in this next cycle. We will buy 3 or 4 of them. Very important to distinguish the good business model and the bad. In the big caps, you have good and bad. As Carlos was saying, you have Tesla, which in our view is not a good model for the long term. And you have good models like Apple. And then going down to the small caps and mid caps, then the risk is much higher. You have really, really very bad businesses that now they can go up, but this will go to 0. So now we are discussing about 5 names, not about 80. And out of these 80 or 120 have already collapsed.
Now, George, you on the other hand, correct me if I'm wrong, but right now you steer pretty much clear of technology, semiconductor, that entire sector.
Well, not by choice,
but by valuation. By valuation,
we did buy a company, but it got taken over right away. Software Arcade. So we only owned that for about 6 months. But what was the list of the names that you that Fred Hickey had in his? Do you have that list? Benichts. Okay.
Yeah. Well, back then it was Lucent, Cisco, Dell, Intel, Microsoft, and the 6th one was, I think, Sun Microsystems.
Right. And so we still talk about Microsoft. That's why we're careful. Because these business models change. When I was a young analyst back then, it was unthinkable that Intel would not lead in semiconductors forever. It was unthinkable. You knew they would. They had the best management. They had the technological advantage. Lucent, I mean, that was a basket case within a few years. But so that's why we're careful. We love, we have no problem with technology. We like software a lot. In fact, we have a very nice software company hidden inside a boring, declining business. Can I?
Sure. Which one is that?
You mean Quadient, huh?
Of course.
Yeah, sure. Yeah, we own a French company called Quadient, who actually makes franking machines. Very boring business, and you should never invest in that because it's declining. But on the other hand, it has a sales force and it has relationships with 10,000s of business customers. And what they can do is they sell them communication automation software. So actually they help them to digitize all their communication with all the clients, and they do that with the Swiss software very successfully. And this, so if we look at Quadient, you get that it has an EPS of €3, and you get it for €17. So you pay 6 times, and you say, okay, that's good for declining business of the franking machines. But the software business actually has the same development as all the other peers in the market, like OpenText or Esker or Bill.com, and they are traded at multiples of 3, 5, 6 times to sales, EV to sales. So if you apply that on those already 200 million of software revenues that Quadient does, you end up with a value of another €17. So actually you get the €70 of the core business, which is the obvious asset, and then on top of that you get the hidden asset of the software business. So we like software, and especially what we like is hidden asset stories.
Would you, George, and I know this sounds like heresy, but could it be that with some of these mega cap tech names, Microsoft, Apple, Alphabet, to name 3, that's this time could be different? They are in a quality bracket. They have rock solid balance sheets, that they just live a life of their own where valuation is not that important.
Well, for now with Apple, you have to say that because we're all locked into Apple. I think most of us probably in here have iPhones. But the problem, of course, is how much growth can they get out of that in the future? But for now, we don't see a competitor to that. Alphabet has a real problem with Bing now. I mean, personally, I now go to Bing. I don't go to Google anymore for a lot of the things I want to find out. It's just easier to use the chatbot. So I think Alphabet has a huge problem. Which one did you mention?
Microsoft.
Yeah, Microsoft. Microsoft had a phase in there where they weren't growing. They always grew well, but they didn't do brilliantly. See, technology isn't always that reliable. But I don't know. I don't know enough about Microsoft's business to tell you if it goes on forever. Probably not. I think from what I understand is they're in the cloud computing business, and their cloud computing is a business where you have enormous upfront fixed assets investments, and then you have low switching costs afterwards. You know, Michael Porter had the oil tanker shipping industry case, right? That's the only case I remember from business school, and that's what the cloud business is going to look like, I think, in 10 years. And so that's not going to be so easy, but will we still have to invest more and more in technology to run the internet? I don't know. I just don't know.
Let's change subject and get away from the tech names. Now, when we talk about value companies, and also some of the companies that nicely outperformed last year, a lot of them are in cyclical business sectors. And right now they get this tough headwind because of a slowing economy, a disappointment in China, a looming recession in the US. Pascal, how do you deal with that? That on the one hand, they are value, they are interesting companies, yet at the same time, cyclically, they are probably running into a tough couple of, or even a few quarters more now. Do you just wait for them to get cheaper and then buy? Or how do you deal with that?
Yeah, let's take that as an opportunity to review what we presented last year. There was Fossil. We had here the management Fossil with us, and the stock was there at $7. And the thinking was, if actually they have a normalized earnings power of $2, and then you put a multiple of 10 times or 15 times of that, so you end up with a valuation of actually normalized, in a normalized world, of $20, $30. And currently it suffered so much by the headwinds, so it came down to $2. So that's where we currently are. So the hit ratio from our side last year was not perfect. Having said that, what we do then? We try to look through if they survive the situation. And what is the future potential of the stock if they still can do the $2 in a normalized environment? And management does just everything to get to deal with the situation. So they cut another $100 million. They actually reinvest into new marketing. They have opportunities building up one of the most stable e-commerce businesses within the sector. They have potential in Asia. So at one day we think growth will come back, and then also the normalized margin will come back. And so we have to be patient, and before that we have to analyze, after analyzing thoroughly, if they do get over this cyclical downturn.
So solid balance sheet is a must, that they survive what's coming.
Absolutely, yeah.
Marcos and Carlos, I know you have, and you mentioned it, Marcos, in the last 2 years, you've had a very good performance with energy and metals and mining commodity companies. Now with them as well, we have this long-term structural issue of probably very limited supply, no capital investments going on, structurally rising demand, yet short-term, disappointment from China, recession coming. Year to date, they've been a terrible investment. How do you deal, maybe Carlos first, how do you deal with that, sort of trying to balance the long-term structural interesting story with the short-term headwinds?
Well, we've always said that in industrial commodities, particularly oil and metals, to understand the price, you must understand that there are three different cycles. And then the price that you see, of course, is the sum of the three waves. Now, since the three waves do not happen regularly, the result is fairly random, what you see on the spot price, but you can understand it. Now, the first cycle, as you mentioned, is there has not been any investment or very little investment in the last 8 years now, or 7 years or 10, depending on the industry. Now, that is going to hit the world very hard in energy in 6 months and in metals in 1 year. And very hard means very hard because, when there is excess oil, it can go to minus 24. But when there isn't enough, it can go to 180. So we've seen both. And that's a very long cycle because then to make more oil or make more copper takes 10 years. So you can be in a kind of an emergency situation that lasts for 10 years. Conversely, when there is excess, until the whole thing is absorbed, it can take 10 years. So this is a very long cycle. Now, over that cycle, and that cycle, by the way, nobody can change anything about that. Saudi Arabia, Putin, nobody can create a copper mine in less than 10 years. It just cannot be done, whatever happens. So that's one thing. Over that cycle, which is certain and relatively easy to document, by the way, because the number of mines being permitted and opened, etc., is public. I mean, there aren't that many. We have a list of all of them. So it's a relatively easy thing to see. Over that cycle, of course, then you have the economy. Of course, if there is a boom, an economic boom, well, there is a bit more demand for these things than if there's not an economic boom. And if there's a recession, well, there's a bit less. Now, that impacts the price, of course. And on that cycle, and this is very important, you have what we call the financial cycle. Oil went down 10% last week. Now this week is up 5%, but it went down 10% last week. Well, that's not because we are in a recession. That's because people think we may be getting into a recession, which is not the same thing. Okay, so this cycle is very violent and very short term. As I said, the same people who sold oil 10% cheaper last week bought it more expensive 5% this week. So that gives you an enormous amount of fluctuation. And to people who don't really understand these things, it really looks like a kind of a random lottery. You buy, it drops, it goes up. What the hell is this? But we do know that there are not enough mines. We know that. And we know that humanity cannot survive without oil. We know that. And we know how much oil can be produced next year, even if everybody goes all out. So this long cycle can give you certainty. Now, when you see all the negative narratives on these things pushing the prices down, well, you may wait, because if you think this is going to keep down, we'll wait a little bit. But it really gives you good entry opportunities if you are clear and confident on the long-term cycle. And by the way, on those commodities, on the long-term cycle, we're now at the beginning. In fact, we're not even at the beginning. People are still not investing in these things. The day they start investing in these things, then we start the countdown to having enough capacity. But they have not even started yet, because then you add ESG and geopolitical issues. So we are going to have a very, very strong commodity markets for a very long time.
We are going to hear the Petrobras case afterwards, after the break. But Marcos, share with us some of your best ideas, both in the energy and in the mining sector. And I know you mentioned Ivanhoe, for example, but others.
Yeah, basically now in the Classic, which is the global value fund, we have now around 20% invested in commodities. The main two ideas is oil and copper. And trying to add a little bit of value here, how we do the DCF model as usual with intrinsic values that basically take the commodity price at incentive price for the modeling. You take the commodity price that is going to incentivize new supply. So that's the starting point. Then you have the volumes, the cost, and you build your model. And this is the mid-cycle. You cannot imagine the volatility of this sector. So you build the intrinsic value because you have several leverage factors. You have the psychology factor of the market, up and down, but then you have the commodity price, which is very volatile. As Carlos was saying, you can go in oil from negative to 150. And this is then you have the leverage of the company. So really, commodities are really high beta. So we build these models and we don't time the market. So last year, 2 years ago, we had 20 to 25% exposure in the classic to oil. This is one of the reasons because we build up when the oil went to negative. And then what happened is that we didn't really have a view on the macro. Basically, what happened is that the oil price went up and the prices went up, and then we sold because it was kind of very near to intrinsic value or even higher. And then we reduced. And now oil is only 12% of the classic. Copper is different. It was a year earlier, but did exactly the same. Up, then we sold. We went to very low exposure, and now we have only, I think, 5 or 6%, and we are building. So if the recession happens, in next year time, if we are here, we will have probably 10 to 15% in copper.
And which names do you own?
In oil, the biggest names are EOG, which I think we presented one of these days, is a US independent. Then we have Canadians, Suncor and CNQ. We have a small UK player named Harbour that is done very bad, but there is a lot of value. And then we have Pioneer. So we have several names, and in the Hess is very interesting.
You have to buy companies that have oil. Most oil companies don't have oil. Hess does.
Hess, they found oil in Guyana, and they are upgrading the reserves every year, and they are huge reserves. We think they're going to keep upgrading. So Hess is a core for us. And in copper, we have Ivanhoe is one of the stocks we have, but basically we have Freeport, we have First Quantum, and Hudbay Minerals, and a little Spanish company which is good, very good. It's called Atalaya Mining. So these 4 names are one of the tops for us. But we have in oil Antofagasta, also the Chilean leader. So, commodities, we try to play it also, and it's not very good for a value investor because we like concentration. But as this sector is full of risks, then we try to run it as a basket. So we always have 3 or 4 names per, not one, because you may have attacks, or you may have a changing regime, or you may have a problem on the operation. So we really try to generate value having 3 or 4 names.
Now, George, obviously one of the big drivers for copper names is energy transition. So the idea that the world economy will need vast amounts of copper. How do you play or deal in your fund with the idea and with opportunities in the wide field of energy transition?
Yeah, sure. We're looking for things where that's misunderstood. So I've got at least, I'll start with 2 stocks. One of them would be Andritz that we mentioned. They build power plants. The old Eschereis belongs to them. So that's hidden it's not hidden, but it's inside a company that builds a whole bunch of other kinds of equipment, such as pulping machinery. That's their main business, which will benefit from the energy transition because pulp mills need more efficient equipment. And one of the things that pulping manufacturers are good at is building boilers that burn what's left over from the logs when you turn them into pulp. So that's a company that in their third business they build stamping equipment. That means the car panels and things like that, and your car may be made on Andritz machinery. Well, you also need that equipment to build battery-powered cars, and you need it to build battery casings. So they're getting orders from that. So they're benefiting from the energy transition, even though they don't have that obvious energy bit. They don't look like a company that's involved in the green transition at first glance. And then another one would be Wärtsilä. They build these huge motors that you use to power ships, 4-stroke motors. For example, a cruise ship will have those. You can use those to generate energy. So they hope to sell lots of these motors to balance power in networks that have a lot of solar or wind, because the problem there is that power is very intermittent. Suddenly well, it gets dark for some reason. Your solar panel no longer works, so you need to have a battery and then a motor to provide the power. They do both. They actually provide batteries, and they have a battery business that's as big as Fluence's. It's better than Fluence's, but Fluence is a pure play. It's trading at a very high valuation and doing the same math as we do with Quadient. We get that it's a hidden asset that people just aren't talking about. In fact, it's a drag on the valuation of the company because for now the battery business makes a loss. And so people very mechanically said, well, gosh, it's worth 10 times EBIT, not taking into account that part of the reason the EBIT is as low as it is because they're building up the battery business. If it was stripped out, they would be giving it a positive value. So, the market's coming around to that. Why the stock's been doing very well. Did I miss one that's on the energy transition?
I'm rather the consumer guy and media guy, so you might have to ask Marcus rather that. I think if you didn't miss one.
Oh, Agfa. Yeah, right, Agfa, which has been a perennial albatross around our neck. But Agfa builds the membrane. Agfa comes out of the film business. That's where their knowledge, their know-how is. And so what they're really good at is coating thin materials with chemicals. That's what they're especially good at. That's what a film was, for those who remember. So now for alkaline electrolysis, which means if you want to take power and convert it into hydrogen, you need a membrane that separates the anode and the cathode. Well, there's one company that makes the best membranes. It's Agfa. They have a lock on the market for now. Now, it's a small market. The revenues this year are going to be something around 25-30 million euros, but it's going to grow like crazy. We all know how much money is going to be invested in electrolyzers over the next 10 years. So as long as they can keep their lead, they are going to make a killing in that business, and that's not reflected in the stock price at all yet.
How come, George? It's not long ago that before the AI wave, 6 months ago, everyone was talking about who are the winners in the hydrogen business because hydrogen will be the big thing, and nobody has ever mentioned Agfa in that respect.
Well, okay, so they're not going to be the only. Membranes are only 1% of the cost of an electrolyzer, from what I can tell. It's very hard to get this information. But still, 1% is a lot if you're spending billions and billions of dollars or euros. And then why don't people know? Well, it's a lot of work to try and figure, the company hasn't said very much about it. You have to do a fair amount of research. I read a lot of boring technical analyses of the cost of building electrolyzers, some of which is old, but it's all on the internet. You can find it. It just takes a long time. And then you have to sort of guess and make some assumptions about what kind of a business it is, what sort of margins it might earn. It's a lot of work, and I think people don't necessarily want to do that work. The advantage if you have when you have a very focused portfolio like we do, is that you have a lot of time to spend on companies, on individual companies. The disadvantage is that you're always focused on a few companies, and you miss a lot of wonderful opportunities that are out there too, because you're so busy trying to figure out what a membrane of an electrolyzer might be worth. So.
I'd like to open it for questions now. Does anyone have a question for any of the four panelists here? You can ask your question either in German or in English, and I'll translate. There's one over there.
Yes, I'm wondering how you protect the various currencies. Value investing can be very interesting right now in England, or it can be very interesting in Norway, but those currencies are going downhill. And of course, you can always hedge it, but there are costs to the hedging too. So is the currencies, is that the part of the evaluation of a company?
Marcos, would you like to go first?
Sure. We basically have a global a global value fund, which basically we consider it that it's a global currency, so we don't actively hedge anything because first, many companies we have are international also. We may have a company listed in London, but they have all the business in another world. So the first comment here is we don't hedge because our approach is global. And then, you have a lot of effects that are very difficult to calculate. The second thing is we hedge if we have a huge exposure. So we did that with the UK housing, for instance. So if we get a big position in a sector where we think that it is maybe a risk, it is local, with local sales, with local cost, blah, blah, then we do hedge, but only if it is maybe more than 10% of the fund. If not, we don't really have a macro view or a currency view. We don't know if the dollar is going to go up or down. So basically, we consider global investment, and we only hedge on a risk basis. We don't have to have kind of surprises.
And George, how do you deal with the currencies?
Same.
Yep. Yeah. Good. I like short answers.
No, I would like to add. You really have to look.
Add one
maybe
thing.
Carlos, just one thing. Yeah.
We did analyze it once whether or not we would have been better off hedging, and the result was, because we're long-term investors that know that the benefit that we would have had in hedging the Swiss franc would have been compensated by the costs of the hedging, and in the meantime, there's a hidden cost to the hedging, which is it's a lot of work. You need to have someone managing those overlays. So it would be a huge distraction in the business to manage that stuff. We would have to hire someone, and so we go with the way the SIA does it.
Now, my point is that today there are very few companies which have currency risk, because you have to look beyond the share price. I mean, of course, a prototypical example would be Nestlé. Nestlé is quoted in Swiss francs, as we all know, but it is not a Swiss company from a monetary point of view. It's 2% of their profits come from Switzerland. If Nestlé were to move headquarters to Paris tomorrow, or to their listing, they would be listed in euro. The profits would be exactly the same. Only you would see a different number, and then you will multiply by the Swiss franc price, and you would get the same number. In some cases, you do get currency risk. Marcos mentioned. Years ago, we had a large exposure to UK home builders. Now, if you own a UK home builder, everything you own is in British pounds, sterling pounds. So the assets are in pounds, the sales are in pounds, the costs are in pounds, the debt is in pounds. So if the pound goes down, well, you've lost money. All your assets are down, that's it. But that is not the case with Nestlé. Or if you own a Norwegian company making salmon, this is very funny. If you are the owner of the company, which is what you are if you are the shareholder, you want to pay your workers more or less, well, if possible, less. So if the crown goes down, you pay in crowns, good for you, but you sell the fish in Europe in euros anyway. So in fact, you're better off, since you don't have too many assets, just costs. You're better off although on that particular day that the crown goes down, you see your share price worth less in francs, for the real profits of the business at the end of the year, you're better off. So, as Marco was saying, it really doesn't pay off. In some cases, you could find there's a reason to hedge, but most companies, Grifols, it's supposed to be a Spanish company based near Barcelona. Practically all their business is now in the US, but it is quoted in euros. So what do you hedge? The euro quote that you see, or the dollar price, which is the underlying thing, but only for part of it. So it's not really doable. And as Marco says, if you owned all the companies in the world, there wouldn't be any currency risk, because currencies are a zero-sum game. Not all currencies can go up or down. So if you have a representative global equity, you have no currency risk in general.
One last question here in the middle.
Unfortunately, this panel was too much concentrated on specific companies, but not on the market overall valuation. Well, it was referred, with the Nifty, not with the Nifty 50, but with the technology boom in the year 2000. The question is, Blash, buy low and sell high. What do you have to buy for the next 20 years, so on? I give you some examples. Well, we haven't talked about market valuation, PE multiples. Microsoft and Apple are traded at the PE of 25 to 30 about. That's considered cheap in comparison with Nvidia, but basically it doesn't say that this market valuation can stay on for the next 20 years. I would rather value even Apple and Microsoft with a basically discounted PE ratio. Another example, the pharmaceuticals, especially Roche and Novartis, were traded not very long ago with PE ratios of 20 to 30. Now they are traded at PEs of 12 or 14. So basically the market came to a very revaluation. But I think now Roche and Novartis have become value stocks. And I think, the market multiples of even Microsoft and Apple are not there forever. That was also said with the proven saying with, for example, the Cisco and all the other companies which were on in the year 2000. So I think that's the interesting thing, where will market value of the overall market go?
Well, that's basically two questions. And I know, and I specifically did not ask about the general market valuation because I know you all are bottom-up investors. But two questions. What are your thoughts on the overall market valuation? And the other question, and I'll make that for the last round, buy low, sell high. So what do we have to buy now because it's low and attractively valued with the next 10 to 20 years in mind? Marcus, would you like to go first?
Yeah, actually, I was looking at valuation yesterday to prepare for the question. And we twice a year, we take a look to the different sectors and geographies, right? So geographies is very easy. The US market is fairly valued, a little bit expensive. Be careful because the returns are higher than the average cycle. So then you don't know what these returns will do. But basically, US is expensive, Europe is cheap, and then emerging markets overall are cheap. So that for the geographies. For the sectors, tech is super expensive. It's trading back to almost highs of the tech bubble, 8 times price to book for the sector. You can go to 10, and 10 is the peak of the bubble of the year 2000. Be careful with tech because, as we discussed, you have good businesses. You cannot go short good businesses like Apple because it's too risky, because they can continue to grow. And the multiples you're mentioning, I think, are all multiples because Microsoft is PE of 40, Apple is PE of 30 this year. So really, if you do the number, Microsoft 1 divided by 40 is 2.5% earnings yield. How much can be the growth long term? It's not going to be 20. It's going to be 5. So your return is going to be 7. And then you will have a derating. So and this is Microsoft. I'm not talking about the bad businesses like Tesla. So good sectors, financials is cheap, energy is cheap, mining is cheap, pharma is cheap, consumer is fair, tech is very expensive, industrials is expensive, which I'm still trying to understand why industrials is expensive. This is more or less what I saw yesterday.
George?
Yeah, if I owned the market as a whole, I think I'd be worried because I think that there's a big risk that those huge stocks with high valuations have a correction. I think they probably should, because you need an enormous amount of growth to justify those valuations, and people will realize that for reasons we've discussed. As you saw from one of my charts, we think that European value stocks. So there's a lot of cheap stuff in Europe. That's what we see. That's what you see from a top-down perspective when you look at the index. We don't look for stocks based on the index. We look for stocks on individual basis, and we see the same thing. So from a frog's perspective, if you will, to translate the German, we see a lot of idea. Well, not a lot. It's never a lot, but you see things in Europe that are particularly interesting that people misunderstand. That.
And maybe short, Pascal and Carlos, what to buy now, buy low, with the next 10 years in mind?
I don't know. It might sound a little bit cheesy, but it's really the thing that I do for the long term. I have all my money invested in our fund. It's a diversified fund of values, deep value titles. Things are changing. We always adjust to that. So actually, that's my personal advice that's what I do.
Carlos?
I would add that's what I do too with our fund. If I had to choose something outside, which is not outside, it is inside, I think energy, in a broad sense, is what the world is going to be most short of and most in need of. So that's the definition of where you want to be.
Thank you. We now break for coffee, but please first join me in thanking Marcos, Carlos, George, and Pascal. Thank you very much.